at a new topic, that is analysis of financial statement. Before moving forward, we need to understand that how many types of financial statement we have. We basically have 7 types of financial statement, but the majors are 4. So that I will discuss it with you. The number one is income statement. The next one is balance sheet. The third one, statement of shareholders equity. Statement of shareholders equity. While the last one, that is a statement of cash flow. Statement of cash flow. So I will give you a very short idea that what are these financial statements all about. Then we will move on to our today topic. Now, if we talk about the income statement, income statement basically provides the summary of the firm's operating results during a specified time period. What I am saying, it provides a summary of the operating results. Summary of operating results. Either we are in loss, operating results in form of loss or profit. So what we need to do, we need to make we can make it at the end of the specified time period, or you can make it on an annual basis as well. Then the next one is the balance sheet. Balance sheet, we already have an understanding of the basic ideology about the accounting equation. Assets is equal to liability plus honor equity. So balance sheet basically provide the information regarding the financial position and the financial health of the company. What it is providing, it's providing the information about financial health or position of the company. Position of company. After reading the balance sheet, you will get better understanding that how many assets company have and how many liabilities and how many equity that company, that particular company has. Now, the third one is the statement of shareholders equity. It shows all equity, the transactions that occur during a given time period. The information about transactions, information about transaction that occurred during specified time period. Specified time period. Now, the last one is statement of cash flow that provides a summary of the firm's operating, investment and the financing cash flow. Operating, investment and financing cash flow. And financing cash flow, and reconcile them with the change in its cash marketable securities during the period. That was the general idea about all these statements, that what all these financial statements are all about. Now, what we have to do in that lecture, we need to develop a particular kind of analysis for both for the first 2 financial statements, which is income statement and the balance sheet. Now, how many types of analysis we have in the order to analyze these financial statements? So we have basically 2 kind of analysis. The first one is the horizontal analysis. Horizontal analysis. Other one is vertical analysis. Vertical analysis. So before moving ahead, we should know that what is the horizontal and the vertical analysis. We have a different name for a horizontal analysis. We normally said it's a comparative statement. Comparative statement. Index analysis. We have a different name for the horizontal analysis. comparative statement and index analysis, and we can say it's a trend analysis. The book we are following, they use the word trend analysis instead of a horizontal analysis. So what we are going to do, we are going to do trend analysis. I'm just giving you an overview that what is trend analysis all about. Trend analysis basically review the company financial statements over the multiple time periods. Number one, review the financial statements over multiple time period. Other idea is that it shows growth in percentage, shows growth in percentages. Third one, allow financial statement user to easily spot the trend. Allow financial statement user to easily spot the trend and the growth. The trend and growth. We will do some practical just to understand whatever I'm writing over there. We'll solve few questions, then you will get better understanding about these terminologies. Then it's a comparative analysis. It's a comparative analysis. And the last one we can add is it shows the company growth and the financial position versus competitor. Shows company growth. It shows company growth and financial position versus competitors. Now let's see what is vertical analysis. Vertical analysis, we have the name for a vertical analysis is common size statement or the common size analysis. Common size statement or analysis. The book we are going to follow, they use the terms common size statement for a vertical analysis. Okay, let's talk about some of its feature. Now one, it's a static analysis. It's a static analysis. And the second one, financial statement of the single year are reviewed and analyzed with the proper techniques. It review single year and analyze with proper techniques. Now we will do vertical analysis in the horizontal analysis, or you can say trend analysis in the common size analysis for both income statement and the balance sheet. Let's take an example to solve the income statement first, then we will get better understanding that what does it mean. So what we are going to do, we are going to do trend analysis and common size analysis for a income statement. So let's take an example. For example, we have an information. Let's say we have following information from ABC company, and information we have (2014, 15, 16, and 17). So we have first net sale. We have basically 1 lakh in 2014, 120,000 in, let's say, 2015, 130,000 in 2016, and 90,000 in 2017. And then we have CGS. We basically deduct it. That is known as cost of goods sold, we have basically 80,000 in 2014, 96,000 in 2015, 104,000 in 2016, and let's say 72,000 in 2017. Okay, but we have in hand, let's say, whenever we will deduct CGS from the net sale, so what we will get gross profit. What we will get gross profit. So we have 20,000 over here, 24,000 over there, 26,000 here, and 18,000 here. So what we are going to do, we are going to do horizontal analysis or trend analysis first. Here we will do trend analysis for the income statement. Now, the formula for the trend analysis is equal to current sale divided by base year sale. Base year sale multiplied by 100. Why I am saying that? Okay, first we move forward. You need to understand that examiner will give you base year first, and then you have to calculate the current year. Remember that current year is always latest year. Okay, current year is always latest year. For example, examiner is giving you base year of 2014. It's giving you base year of 2014. Then what would be the current? What would be the current year? The current year would be the 2017. Okay, that is the latest and the current year. But if somebody asks you in the question that you need to calculate the you need to calculate the net sale of the 2014, then how we will calculate? Let's say for the 2014 current year sale is 1 lakh, and base year we also have 1 lakh. So 20 multiplied by 100, so we will get 100%. Okay, we will get 100%. Remember that we are going to do horizontal analysis. So horizontal analysis something like this, and the vertical something like this. So what we are going to do, we will make a comparison of the net sale between the years 2014, 15, or 15, 16, and 17 onward. So what we are going to do, we are doing analysis in a vertical shape like this. Whenever we will do the vertical analysis, we will move in this form. Okay, so that was the 2014. Let's say 2015. They're saying that base year you have 1 lakh in 2014, and you need to calculate, you need to find a trend analysis for the 2015. So how we will calculate for the 2015? So we have current year sale is 120, and base year we have 1 lakh. Whenever we will multiply by with 100, we will get 120%. Now, remember that we start from the base year. Why we need use the base year? You need to understand between the ratio and the percentage in order to understand this question. Percentage we normally said we shows it with like 100%, and ratio we said it's a 1. So value should be less than 1 or greater than 1. Whenever value would be close to 1, or let's say its a value is like 0.9. So what we will say that sale are lesser than or the ratio of the sale are less as compared to the base year, as compared to the ratio. We are making a comparison between 0.9 and the 1. If the value we have, let's say 1.1, so what we will say that 1.1% sale has been increased as compared to the last year. What is the comparison point? The comparison point is this. Just like in a percentage, we have a comparison of this one. Like in the base year, we have net sale of the 100%. In the next year, we have a 20%. So what we will say, 20% sale has been increased. So the net sale, at this is a difference. Trend sale has been increased. Let's come on to 2016. 2016, we have basically 130,000 and 1 lakh for the base year. When we will calculate it, we will get 130%. Now you would see here 20% increase, here 30% increase. So you can find the trend, that the trend has been set, the net sales are growing with the passage of time. Now, what is the idea about 2017? It's 90,000 sale, base year will remain 1 lakh, multiply by 100, and what we will get 90%. Now what you will say, that 10% sale is less than from the base year. Okay, that is the idea, or that is the ideology behind the horizontal and the trend analysis. Now what we have to do, we have to do common analysis or the vertical analysis. Let's come on to that point. Common size analysis. Same example we will take. The formula for this is cost of CGS divided by net sale, or you can say divided by obviously net sale. Let's say, for example, we wanted to do common size analysis for net sale. Again, we are going to do for a net sale. Now remember that we will move like this. Okay, so what we are going to do, we are going to calculate for a 2014. So 2014, we wanted to calculate the formula for, let's say we wanted to calculate the for COGS. Okay, so formula is COGS, cost of goods sold, and divided by net sale. So how much we will get? Cost of goods sold is 80,000, and net sale we have multiply by 100, 1 lakh. Whenever we multiply by with 100, so what we will get 80%. That for cost of goods sold. Base year will remain same, although they will give you that what would be the base, but that would be the base. Okay, then you will calculate the gross profit or the CGS percentage accordingly. For a next year 2015, the base year would be 120, and for the next for 130, and then what would be 90,000. For example, if we wanted to calculate for a gross profit, then how we will calculate for the gross profit percentage? Then 20,000 for 2014, and base year would be 1 lakh multiplied by 100. So whenever we will multiply by 100, it would be 20%. Okay, so gross profit, what it basically suggests that in net sale of 1 lakh, okay, 80% is cost of goods sold. 80% is cost of goods sold, while 20% we have a profit. Okay, if somebody asks you to calculate the base, so always remember that net sale would remain 100% always. The base year, whenever you will calculate the trend or the common size analysis for the base year, answer would remain 100%. So net sale, so it would be like 1 lakh, and the 1 lakh, whenever you multiply by with 100, you will get 100%. Okay, so out of 100%, we have 80% cost of goods sold, you can calculate the gross profit something like this, that 100% minus 80% divided by whenever you will deduct it, you will get 20%. You can calculate it something like this. So that was the trend and the vertical analysis for the income statement. Let's come on to the trend and vertical analysis for the balance sheet. Let's take an example. Balance sheet. Let's say we have current assets. For example, for 2007 and 2008, we have cash, account receivable, supplies, inventory. For example, for 2007, we have 10,000 cash, 8,000 account receivable, 4,000 supplies, and 2,000 inventories. Overall, it would become 24,000. That is total assets. Let's come on to 2008. So it would remain let's say 12,000, 10,000, 2,000, and 1,000. So that becomes 25,000. Let's calculate the percentage for 2007 and 2008. So remember that you have a formula, is that current assets divided by, so what we are going to calculate, we are going to calculate the trend analysis. You will make a comparison. Okay, what we are going to do, we are going to make a comparison between these two. For example, we have 10,000. So 10,000, whenever we will divide it with the base year, let's say is a 10,000, so that would remain 100%. So all these things would remain 100%. Let's come on to 2008. So what we need to do, the current year, which is 12,000, let me calculate. Current year is 12,000 divided by the base, which is 10,000, and whenever we multiply by with 100, so how much we will get? We will get 120%. And for this, 10,000 divided by 8,000 multiplied by with 100, we have 125%, like 25% you can say, and then you will calculate it. For that, it would become 50%, and this would become again 50%. Okay, that was the idea for a trend analysis for the balance sheet. Let's come on to the last one, which is vertical analysis. So let's calculate 2007. For 2007, the formula would be is current asset divided by total asset. Keep in mind that is a simple difference, total assets. So let's say we are calculating for cash. Okay, so cash would be, we have 10,000, it's a current assets, divided by total, which is 24,000. Okay, so for the cash we have 42%, and then we will calculate 8,000 divided by 24,000, so it would become 33%, and then for the next it would become 17%, and then 8%. So these were some trend analysis, the vertical analysis for both income statement and the balance sheet. Hope you have a better understanding for the